A lovely morning to all of you. This is Magdalene from Itus Capital, and I'm glad to welcome you all to our 3Q Investor Call 2025. Thank you all once again for taking the time to be a part of our Saturday call. At this time, all the participants will be on listen-only mode, and after a brief presentation by our founder and fund manager, Naveen Chandramohan, we will have the Q&A session. Today, Naveen would walk us through on our portfolio's performance in the last quarter gone by and discuss his views on the market. Let's hear from him now. Over to you, Naveen.
Thank you, Magdalene. Hope you can hear me clearly.
Yes.
Thanks, everyone, for joining this call on a Saturday morning. Like Magdalene also mentioned, in this call, we like to do the following. We'll start off by reviewing the performance. We'll take you through the three levers of the macro environment that we are in today, talking about flows. What does it mean for us in terms of earnings? How is the current macro? And within that, how are we portfolio positioned as we speak? And finally, we'll end the call around what we are monitoring and what do we expect in terms of earnings over the next 6 months. Post that, we'll open the floor to Q&A, be it in terms of any portfolio-specific questions or the overall broad macro that we're talking about. In terms of the performance of the fund, since inception, if you look at the fund, 1 CR invested in the fund is roughly worth 4.16 as against the benchmark at 3.35 CR. Now, while there has been a healthy outperformance across time, two things stand out. Over 4-year cycles, when you look at the performance of the fund in every 4-year cycle on a rolling returns has CAGRed at around 18% post fees and expenses, which effectively means doubling of money every 4 years, which is our base case in terms of how we think about it in the future as well. Now, one of the more important aspects of running a single strategy fund and focusing in terms of downside protection is how have these returns been achieved, which means while Nifty 50 has been one of the most stable benchmarks, not just in India, but globally, have we ensured that this volatility that we go through over time, has that been truly risk adjusted? And when we measure it, today, our volatility stands lower than that of Nifty 50, along with a beta, which is lower than that of 1, which effectively means risk-adjusted returns has truly been superior than that of the benchmark. Coming to the returns on a year-on-year basis, for people who have been with us for a while, some of you are aware that Jan and Feb were weak returns for the fund against the benchmark, where we had underperformed because of our pharma exposure. Post that, in the March quarter call, I had mentioned that this underperformance should reverse, and that's what you are seeing over the last 2 quarters. The underperformance against the benchmark has narrowed because the subsequent 2 quarters we have seen outperformance, and the same has been carried through in the June to September performance as well. And since inception, the fund has generated a post fees and expense IRR of 17.69% as we speak. Moving on to what we are seeing in terms of flows. Now, there are 2 kinds of flows that matter, which are reported on a monthly basis. One is the FII flows, which has been on a downturn for the last 5 years structurally. And second is the DII flows, which has been on a one-way trajectory up in the last 5 years, more than compensating for the FII flows. Today in this call, I want to take a slightly different approach than what is normally discussed in media or by the industry in terms of FII versus DII. What I want to zoom out a bit more is to speak about FDI versus FII. So the figure 1 that this chart represents shows you over time the FDI flows, which is in dark blue, as against the FII flows, which is light blue. Now, there are 2 things that you will notice on this chart. It's just not today. Structurally, over the last 15 years, FDI flows tend to be a lot more stickier. Now, what are FDI flows? These are flows that typically come into India from an infrastructure perspective or a ports perspective or airports perspective. These are slightly more ownership of asset-based investments. It could take 10, 12 years for them to realize value. And hence, these decisions are not taken purely on the basis of what is my or what happens if my currency depreciates and hence I lose money. FII flows, on the other hand, adjusts for this, which is why you will see a lot more volatility in the FII flows, not today, but even in the past, right? Now, interestingly enough, the second chart shows predominantly what is happening to FDI flows, which means this blue dotted line shows you the repatriation as a percentage of gross inflows, which means as the FDI structural investors begin to realize value, they might want to take it out of India into their home country. And the green one shows you the net value. So you saw that the last decade between 10 and 23, the net inflows was close to 40%, which is gross minus redemption. In the last 2 years, the redemptions have increased and the net value has decreased. Now, this is a function of two things. This is a function of A, the previous cycle of investments realizing value, and two, a recycling of capital into the next cycle of investments. And as you can see, this FDI flows is the net flows are actually picking up slowly as a period after a period of 2 years. It's not yet reflected in the FII flows. As you can see, the outflows continues to come from FIIs, but FDI has seen a recycling of capital and a pickup early this year. It's important to understand this and keep this in context because this has implications around what could happen in India over the next 2 to 3 years. So, with this as the background and just keeping this at the back of the mind, let's look at global markets as against where India stands this year. As many of you are aware, India has been an underperformer, relatively speaking, versus the rest of the markets. Many of the markets, including China, Japan, Europe, and US relatively, has outperformed against Nifty 50 or the Indian benchmarks. And this is something which needs a little bit of explanation around can it reverse and what could cause it to reverse. Now that we've seen what has happened to flows, which is obviously something that's already happened in history, let's just look at what has that meant for earnings in the past and what is the analyst expectations over the next 2 years. As you can see, post-COVID, because of the base effect, there was a very strong earnings growth recovery in corporate India for Nifty between 22 to 24. The same base effect that helped India is now hurting, which means FY25 you saw a drop and FY26 estimates you see a further drop. Now, if you had looked at the same number in my March presentation, I had spoken about this number estimate at close to 11.5%, which means as 2 quarters of earnings are coming through this year, analysts have cut the earnings this year, which is one of the reasons in the December quarter 24 letter, if you had looked back, I had spoken about the next 1 year being a period of both narrow and lower earnings growth. However, so far at least, FY27 earnings growth seems to be pricing in roughly around a mid-teens earnings growth as we speak. So today, if you look at it, earnings growth has been cut down and there is a potential possibility of this getting revised further down as of the September quarter. Now, this is what I had spoken about in the past prior 2 to 3 calls. So if you look at the June quarter earnings that has come out, what we have done or what the figure 5 shows is the overall Nifty 500 companies, which roughly represents 85 to 86% of the PAT of corporate India. How have they shown revenue growth both on a free float adjusted basis and an equally weighted basis? What's the difference? Free float is how any index in India is constituted, which means it's adjusted to the market cap. Equally weighted assumes that each company has the same weight depending on the number of names in the index. What is the relevance of this? When earnings growth is broad based, you will see equally weighted being a lot higher than free float weighted. When earnings growth is narrow, then a fewer set of companies are driving your averages, as a result of which free float weighted tends to be a lot higher, right? So one of the things that we monitor, it basically gives you a sense of the depth of earnings and how broad based is it versus are fewer companies driving it, and that's important around how you build portfolios as well. The second thing for us at Itus is also to see in each segment how are our companies doing in each one of the categories against the overall market. So not only do you want your growth to be higher, which is one of the levers, you want it higher across different kinds of market caps. And that's an important lever for us, along with certain other levers like margins and valuation. But this gives us a sense to basically say, are we positioned in the right areas of growth? Now, breaking this further, if you look at each sector, what we have done here is sector-wise breakdown of where are we positioned against that of Nifty 500. The next column refers to the weights of our portfolio against that of Nifty 500. So, for example, you will see certain pockets like consumer, chemicals, or metals, or healthcare and hospitals, financials, where we are overweight. And certain other pockets like banking, auto, maybe a cap goods, where we may be relatively underweight, or for example, let's say IT, where we are significantly overweight. So each pocket tells you where we are positioned, and against that, how is our sector growth panning out against that of Nifty 500? So a dark green basically says a significant difference in earnings, or rather top line growth of our portfolio companies against that of Nifty 500. And this is monitored alongside margins, because what is really important for us is how well are the margins accreting into your cash flows for your balance sheet to become healthier. So not only do you want growth to be high, you also want your margins to be relatively held in or hopefully expanding, which is what you generally call as a good company which is gaining market share. So these both of these tells us, are we positioned in the right sectors? Previous two charts explains to you, are we positioned in the right market cap? And finally, from a bottom up perspective, are we positioned in the right company? Now, the question becomes, as you saw, there has been a continuous downgrade of earnings in the last 2 to 3 quarters. And I'm telling you that the September quarter, there could be one last downgrade. Now, end of the day, a lot of this is the reason why India has relatively underperformed and FII flows have not yet come in, like what many people should anticipate or would anticipate. So, what can cause this to change? Now, if you look at it, unlike China, which derives roughly around 28% of its GDP and PAT from manufacturing, for us, manufacturing is a lot lower today as we speak. As we speak, roughly around two-thirds of our GDP and market cap is coming from the consumption sector. Not only this, our net profit of effectively corporate India, of roughly around the top 500 companies by market cap in the listed universe, again comes from consumption. So, end of the day, if you think about what should be done to revive growth, you need this consumption to go up. So, if you think about what the government has been doing in the last 9 months and superimpose this with where your economy is, certain aspects will align to basically say A, interest rates have been cut, B, tax benefit has been given, GST has been cut. All of this is effectively to revive this two-thirds of the economy. So there is a certain belief right now that this segment of the economy can give you a kickstart over the next 2 to 3 quarters to drive growth. And the government is focused in terms of this. And one of the primary reasons that we have not seen our cost of capital at this level in the last 20 years is because it's an intentional effort by the government to keep the cost of capital low such that consumption can increase. And within this macro, Indian macro globally is extremely accommodative in order to drive growth. So if you look at the RBI's projections over the last few meetings, each one of those projections have been in line with saying that the inflation environment is relatively low. Our cost of capital has been kept low, and every effort has been by the government in order to actually bring lending back and kickstart lending back into the economy, right? Which, if you then superimpose it into what could happen, it should result in a consumption growth. So, with this as the background, it's really important to basically say going forward, or rather 2 quarters out, it is our expectation that your leg of growth that has been lacking for the last 4 quarters should come back from the December quarter from a consumption oriented perspective. And if you look at it, our overall portfolio has been aligned with a certain element of being overweight on consumption, overweight on certain other sectors, but consumption does form a certain core part of our portfolio. Now, there are two other themes that I would want to slightly look forward to from a 3 year perspective, right? What I basically covered in the first half was walked you through the last 3 quarters around what has performance been like, both at a relative and absolute level, what has caused earnings growth to narrow, and what have the steps been from the government and where we are today versus what we should expect in the next 3 to 6 months. Now, if you take a slightly more longer dated view, I'm not saying 10 years, 15 years, I'm taking more of a 2 to 3 year view. There are two themes that I think merits attention. A, which is already in our portfolio, and B, which will increase its weights in the portfolio at the right price. One is a sector called consumer tech, right? So, for example, we are used to consumer, we are used to consumption, but consumer tech is more of a relatively newer sector. Obviously, this sector is a very difficult. Some of these companies have platform like characteristics. What do I mean by that? You will not see too much of competition because it takes time to build and scale such businesses. Cost of acquisition generally tends to be high in the first 10 years of such businesses. But once it's done and you have a very strong ability for you to have acquired customers and provide value, operating leverage flows into the business. So typically, these are businesses that can grow at 20 to 25% plus from a top line basis, may not translate into EBITDA in the early stages of their growth, but once they reach an inflection point, the EBITDA also begins to flow through and operating leverage comes through in a significant way, which means your 20 to 25% top line growth can translate into a 30 to 40% bottom line growth at the right point of time. The risk around these businesses also is your traditional metrics of using PE for valuation may not always be the most appropriate way to think about the business, because you cannot value it on today's earnings. You will have to take a call on 3 years out. How could the business look like, and give it a forward multiple? And that is where things could go wrong. Now, there are certain macros when such businesses tend to do well, which is periods of low interest rate. Now, if you look back in history, right, the period of 10 to 22 or 10 to 23 in the US, obviously, US, many of you are aware, US was the best performing market. And I've been talking about US could be one of the worst performing markets this decade. And that view is something I still continue to hold. But one of the reasons why US was the best performing market was the fact that its cost of capital kept coming down in the last decade. And hence, technology companies, which in FY12 used to be 9% of S&P 500, as of 24 is at 24% of S&P 500, which means roughly a 3x improvement in weights. And that means some of these companies have given you 6 to 10x returns over that decade, primarily because when cost of capital comes down, your terminal value of the business goes up. So you get rewarded for disproportionately for owning terminal value in simple DCF modeling. So you want all of these conditions to align itself for you to actually make disproportionate money. To summarize, you need strong growth. You need operating leverage, which means the company must have turned around in terms of moving to a negative to a positive. And hopefully, you need an environment of low or lower interest rates that will help your terminal value growth. So, that is one thing that we see as the environment over the next 3 years for India. Second is chemicals. Now, this is a slightly completely different sector. Over the last 3 years, you will see if you measure it as an industry, earnings growth has significantly dropped. It used to have a very high base, especially post COVID. It was artificially inflated. It had to get reset. But because the balance sheets of some of the companies were very strong, they continue to invest in capex. So, to put it into perspective, some of the well run companies which have strong gross margins have improved their gross block against FY21 in FY25 three times, which effectively means today their return on equity will look extremely depressed. And as this utilization improves, you will see this ROE expand in a non-linear way. And I think this, again, this theme is going to be an interesting theme to play out over the next 3 years. It may not have an immediate effect in the next quarter or so, because you need some amount of the tariff noise also to settle down, because this is more of an export oriented theme, unlike consumer tech, which is going to be more of a domestic oriented theme. So, two themes to actually keep in mind from a slightly more 3 year perspective. And there are names in our portfolio to actually reflect both the themes. You might see more of this over the subsequent few quarters. What we are monitoring from here, right? So the big question that many people ask is, today, will FII flows come back? Like I said, we have seen 2 very strong years of FII outflows along with currency depreciation. Now, when you look back from FY10 to FY25, every time you have had outflows along with 2 years of currency depreciation, the subsequent year has seen FII inflows come back. Now that FDI inflows are coming back from a recycling perspective, I think over the next 2-3 quarters, you should start seeing FII flows also come back as some amount of capital gets recycled out of the US into geographies like Europe and Asia. Second is RBI liquidity. RBI has been fairly loose from a monetary and fiscal policy, and I expect that to continue over the subsequent quarters. Earnings revision, I think you should start seeing potential upgrades from the December to March quarter onwards. It may not, it should, I'd be very surprised if I don't think it will happen in the September quarter, but September quarter, even if it is a washout, should get brushed away because you have the festivity season numbers coming through only in the December quarter. So I think December and March 26 would be your earnings revision upgrades, because most of your downgrades should have flown through post this quarter earnings. So this is broadly how we think about the macro over the next 6 months. To summarize, I think right now, from a sentiment perspective, when I talk to investors, most investors blame two things: A, lack of growth, and B, valuation. I think for markets, when growth comes back, valuation is a reflection of growth and not a standalone number. So the more important question is, what is the environment for growth to come back? And I think we have the right macro for this growth to mean revert over the next 2 quarters. That should start getting aligned with FII flows coming back. DII flows are strong, and that I think should continue at a average level of where we are today. And I think interesting sectors will emerge. One last thing that I did not talk about is our view on capex. I do think capex is happening as we speak. and you will see a very different kind of capex come through over this next cycle versus what we are used to in the last 10 years. I'm not addressing that on this call, but if anyone has any further questions relative to capex, I'll be happy to take that in the Q&A session. So with this as the background, I'm going to pause here and I'll open the floor up for questions in order to take both either macro or micro level questions.
Thank you, Naveen, for the update. Investors who have questions can feel free to type your questions in the Q&A button. Identity of investors are asking questions are protected as the questions are only visible to the panelists. Naveen, I have multiple questions of this. How do you look at the metal sector, uh, especially gold and then also silver? If you could touch upon both of these.
See, I think today, again, so let's take a step back, right? Psychologically, gold was meant to be a part of the portfolio. Today, gold is now becoming an asset class that people are looking to chase. Now, the reason they are looking to chase it is they are looking at it from what returns gold gave over the last 1 year versus equities. And when your 1 year returns are non-linear, right, it will go and affect every period in the past from 3, 5, 10, 15. So you will see many charts to basically say, look at 15-year returns of gold, it's higher than equities. All I would ask you to do when you look at such charts is please look at that same chart 1 year back, and that chart will look very different. So I think people are reacting to price, and it's only human nature to react to price. So I personally think that you are in an environment from a 3, 4 year perspective. If policy continues the same way, dollar should depreciate. I've spoken about this over the last 3 to 4 quarters, and I think this is structural. In that environment, effectively with the way tariffs are going, central banks will have to continue to buy gold. And as a result of which, gold being a part in your portfolio makes a lot of sense. What I'm seeing many investors do is go out of equities into gold, start levering up in gold, use ETFs to buy gold. So, for example, this week, if you had seen the silver ETF versus the silver price in India, it was trading at a 21% premium, which means if silver price is 100, your ETF should have been priced at 100. It was priced at 121, which means people are willing to pay a 20% premium to buy silver. This is what is generally what is called as inducing volatility. So this is not healthy for the market. So short term, I think all of this means volatility is going to significantly increase even in an asset class like gold. If people are to look at a 3 year view, constantly pricing in the fact that a gold could easily correct 10 to 12% in the next 6 months, I think gold should still be a part of your portfolio. So, from a structural perspective, which when I say structural, I don't talk beyond 3 years. I am bullish metals, especially metals which have both an industrial and capex oriented play. And that's something that I think people should consider around how to incorporate this as a part of the portfolio. But if you're asking for a short-term view, I think volatility is bound to increase when I look at price action the way it is.
Thank you, Naveen, for that. My next question. How do you see platform businesses evolving as we have platform businesses in our portfolio? Do you think that they will be able to charge clients down the line and that attributing to the revenue?
See, I think end of the day, if you look at the Indian marketplace likes to pay for hidden fees. That's our market, whether you like it or not. If the fees are transparent and out in the open, people don't like to pay. But if it is hidden in the form of platform fees, people don't know. That's the way we have paid for things. So platform businesses, once you have a user base, today, if you look at it, even a telecom is actually a platform business because it's a duopoly. So when Airtel raises prices, and they have done it in the last 3 quarters, you may not know this, but incrementally your bill has gone up 20-25%. So I think at a certain time, depending on the competitive landscape and the stage of the business that you are in terms of how you are investing capital, platform businesses 100% have a very significant operating leverage that people will not price in. Now, the problem with platform businesses is, like I said, you can't value it on TTM. You have to value it on 3 to 4 years out. So when you value it on 3 to 4 years out, you are kind of thinking like a potential VC investor. The problem of you running a public markets fund and thinking like a VC investor, in a VC fund, you don't know what your value is. In a public markets investor, you know what your value is every day. So a business can fall 25-30% over any period. And as investors, everyone reacts. So it's very different. So there are two jobs in order to actually manage this. One is a selection job. Do you own them? But the more important job is how much do you own as a part of the portfolio and how do you risk manage that? So as I said, we are very bullish platform businesses, but to risk manage each position, what percentage of the portfolio you own such that when you are faced with volatility, you don't have to or you're not forced to sell is the bigger and more important question. But to answer the question, can they charge? At the right part of their operating cycle, they can charge.
Understood. Thank you, Naveen, for that. What is your view on the banking and automobiles in the portfolio since we are slightly underweight on both sides?
So banking is something, okay. So I'll give you my big picture view on banking, right? Banking is obviously one of the most important bellwethers for the Indian economy. And because our debt markets were under-penetrated, you could still argue are, and equity markets were not the go-to market to raise capital, banks were the core engine for you to drive credit growth. Today, as corporate India develops, there are both the debt market available to investors as well as QIPs and IPOs coming out, which becomes equity market getting raised. So banks, though they are extremely healthy and are in the best cycle of credit growth, may not have the same growth that you saw in the previous cycle. So most of them who basically say my price to book of HDFC Bank was 4.5 in 2015 or 16, and today it is 2.1, and hence it is cheap. I think I'm not looking at this part of the equation around growth. So this 2.1 will look cheap if credit growth comes back. So the more important thing is credit growth coming back. And I think that goes into the next leg of the equation. If consumption is going to get driven, that has to flow through into private capex. And if private capex is going to come through, which is my belief that it will start coming through in another 2 quarters, how is it going to get funded by? That private capex can get funded from 3 areas rather than one, like what it was in the previous cycle. So banks are important. I'm not saying they're not important, but today every bank has a strong balance sheet. So end of the day, the competitive intensity is also increased. So it then becomes really important. What is the need for you to overweight banks if I can get growth in other areas? So it is not just saying I want to be underweight banks. It is a relative equation because I have 100 rupees to deploy. If I get growth in certain manufacturing or consumption businesses, I might want to underweight bank into this. If I don't get growth, then I might want to bring it back into banks because there is valuation comfort. So the next 3 years, the way I see it, I don't see our portfolio to be structurally overweight banks, but we will own 2 to 3 banks depending on the cycle that we are in. That's our current thought process today. With respect to auto, as you are aware, auto has done very well in the last 2.5 months, predominantly from a GST cut perspective. Here again, it's not like we don't own auto. We do have, I've been speaking about this, our exposure is more so in the two-wheeler space, and that's something we'll continue to own. In four-wheeler, auto, I continue to think is cyclical. Uh, if you look at capex from auto, it has not happened in the last 1.5 years. And I think that is bound to change. Why do I say that? In the next quarter, you should see Vahan sales come through in a slightly aggressive way, which means inventory in the system should come down. Capex should get aggressively deployed by some of these auto companies in order to clear up the inventory. When auto companies are doing capex, is that the right time to be owning them? In the history tells you that may not be the best time to own them. So I think you had an auto cycle that's done well in the last 3.5 years. It's going into the fourth year. So I don't see from a risk reward perspective being overweight auto today is something that is prudent. From a pure risk management perspective, as a sector, I don't see us being overweight. Will we own bottom up stocks in certain pockets? Answer is yes.
Understood, Naveen. Got it. Naveen, how do you think the tariffs which were announced yesterday on China, how would it impact India per se?
See, I think you are we try to. I don't think anyone can have a view on tariffs because the person who's announcing this also is doing it depending on the situation and the revenues that he's collecting on a quarterly basis. So, in India, the natural thing to basically say is whatever happens, it is bullish India, right? If tariffs announced, we basically say China will get hurt, India will benefit. If tariffs not announced, we basically say this will get resolved and India will benefit. So I think for us, the narrative is whatever the world happens, India will benefit. I don't think it's that obvious. I think my view, considering how all of this evolved, and again, this is a view, I can't substantiate it because a view is something that you build basis history. Why did India get punished? Because come January 25, if anyone had basically said India will get punished, people would have laughed it off because all of us had the same narrative that China would get tariffed, India would be the maximum beneficiary. 9 months out, that certainly hasn't been the case. The only view that I think is the most rational view, according to me, is India was used as a scapegoat to try and see can Russia and Ukraine settle. And because Russia and Ukraine did not settle, we were basically used as a scapegoat in multiple avenues to basically say we should not be buying oil and we will get tariffed because we do have very strong diplomatic relationships with the rest of the world. Now, today, if you not just read the headlines, if you read Supreme Court judgment, the Supreme Court is also basically going to the presidency and saying that he should not be affecting the diplomatic relationships with India. But is he going to reverse? Answer is it's anyone's guess. My likely stance on this is I think he will reverse it in a slightly more muted way. How the terms of that reversal and diplomatic relationships will be, I think that is yet to be seen. But in the next 2 to 3 months, considering volatility in the US, because he is a capitalist at heart, which means when the markets fall, he will react. And I think that this should result in some kind of a resolution. It may not be perfect, but it will be better than the current environment that we are in, which is a 50% tariffs. So I think we've seen the worst in my view. I think we should be better from now. But I'm not going to comment on the fact that if he put 100% tariff on China because they did not give him rare earth, that's beneficial to India. Answer is no one knows. You are in an uncertain period. So that part of it is up in the air. So I think people need to realize that in the next 2, 3 years, whatever view you take, because I've seen a lot of investors saying that they are getting very bullish China, they're getting very bullish Europe. I don't think you can make such easy statements saying I'm getting bullish a country, I'm getting bearish a country. I don't think the world is that straightforward anymore. So big picture, I think we've seen the worst. Will in US and China have additional noise? Answer is yes. And from time to time, India will get affected as a result of it.
Naveen, my last question. Now, the portfolio is more skewed to large cap. What would uh, make you to change, look at mid and small cap over the period?
So I don't think we think about it from a large, mid, or small perspective, right? We think about it from, like I said, I showed you how we think about it. One is how are we positioned from an overall growth perspective? And within that, which segment of the market is giving us growth? And if we have to go down the liquidity curve to get growth, then we need to get paid a significant premium in the form of growth to go down that liquidity curve. So for us, it is not large, mid, or small. It is about saying where are we getting growth and are we getting paid to take that growth. See, even today, it's only 54% of our portfolio which is in large cap. And that also does not give an investor the full picture, because if you measure our active ratio, which is how different is our portfolio against Nifty 50 or Nifty 500, it's at 72%. So effectively, what I urge investors to think of is not whether we are a large or a mid or a small cap, but what is our active ratio, and relatively speaking, how are we positioned? So it's not like we don't have a mid and small cap bias, right? So roughly 45% of our portfolio is in mid and small cap, which in this environment I still think is relatively high. Do I want to go higher than that? I don't think so. Not right now.
Uh, Naveen, thank you so much for the update. Uh, Back over to
Thanks, Naveen and Ajit, for the Q&A session. Once again, I thank you all for the patience on the call. And the recording of this webinar will be sent out by this week. Thank you all.
Thank you to everyone for this.